What if I told you that the price of oil is about to hit $200 a barrel, and that 60 days from now, when you pull up to the gas pump, the number on that screen is going to be something you have never seen in your lifetime? What if I told you the proof is already sitting in public data, in shipping records, and satellite images over oil fields, and in the private communications of energy ministers, and not a single mainstream anchor has connected the dots? That is exactly what this video is about. Stay with me, because in the next 20 minutes, I'm going to walk you through every single piece of evidence, step by step. And by the end of it, you will understand why the global oil shock nobody predicted is not a theory. It is already in motion. Before we get into the data, I want to ask you something quickly. And I genuinely want to know the answer. Drop a comment right now and tell me where in the world you're watching this from. Whether you are in the United States, Europe, the Middle East, Asia, or anywhere else on this planet. Type your location in the comments below. I ask because what is about to happen in the global oil market is going to hit every country differently, and I want to see how many parts of the world this community actually reaches. So type your city, your country, wherever you are. Let us see the map. And if you are new here and you found this video, do yourself a favor and hit subscribe right now and turn on the bell. We cover the stories that the financial media is either too slow to see or too afraid to tell you. This is one of those stories. Now let us get into it. To understand why $200 oil is not a crazy headline, but a mathematical outcome that is already baked into the current system, you need to understand how the global oil market actually works. Not the version they teach in basic economics class, but the real version. The version where geopolitics, debt, currency wars, and physical infrastructure limitations all collide at the same moment. Right now, as you watch this, the global economy is consuming approximately 102 million barrels of oil every single day. Let that number land for a second. 102 million barrels every day. That is not a peak demand number. That is not a projection. That is the current daily baseline according to the International Energy Agency's most recent data. And that number has been climbing for the past 18 consecutive months as China's post-reopening demand accelerated, as India's industrial expansion continued, and as aviation globally returned to near pre-pandemic levels. Now here is where it starts to get uncomfortable. On the supply side, the world's ability to produce that oil is not keeping up, and the reasons why are not random. They are the result of a decade of deliberate decisions made by the world's largest oil producers. Decisions that were made quietly, with very little coverage in the Western press, but decisions that are now coming due all at once. Let us start with OPEC+. For the past 2 years, the OPEC+ alliance, which includes Saudi Arabia, Russia, the UAE, Iraq, and 8 other major producers, has been implementing rolling production cuts. The stated reason was to stabilize prices. But what has happened underneath those cuts is something far more significant. The production infrastructure that was idled during those cut periods has not been maintained at full readiness. Wells that were shut in are not all ready to come back online at the turn of a valve. Some of them require weeks of preparation, some require months, and a number of them, particularly in older fields in Russia and parts of Iraq, have experienced what petroleum engineers call reservoir damage, meaning the physical geology of the oil field was altered by the shutdown, and restoring full production is no longer a simple matter of turning things back on. Saudi Arabia, which the energy world has always treated as the global swing producer, the one country that could always open the taps and flood the market with extra barrels when prices got too high, Saudi Arabia's spare capacity is not what the world believes it to be. The official number that the Saudi government releases is approximately 2 to 3 million barrels per day of available spare capacity. But independent analysts who track satellite imagery of Saudi oil fields, tanker loading data, and rig activity have been quietly revising that number down for the past 18 months. The real available spare capacity, the oil that can be brought online reliably within 30 days, is likely closer to 1 million barrels per day. And in a market that consumes 102 million barrels daily, 1 million barrels of spare capacity is not a cushion. It is a rounding error. Now layer on what is happening with Russia. After the Western sanctions imposed following the invasion of Ukraine, Russia rerouted most of its oil exports to China and India through what became known as the shadow tanker fleet, a collection of older vessels operating outside of Western insurance and regulatory systems. For about 2 years, this workaround functioned well enough to keep Russian oil flowing, but the G7 nations have been systematically tightening the sanctions net. Insurance brokers, port operators, and logistics companies in third countries that were facilitating these shadow shipments have been targeted with secondary sanctions. The shadow fleet's ability to move Russian oil efficiently is deteriorating quarter by quarter. Here is the number that matters. Russia was exporting approximately 5 million barrels per day before the invasion. The most recent credible estimates put actual current exports at between 3.2 and 3.8 million barrels per day. That is a gap of 1 to 2 million barrels per day that has been absorbed by the market. but only just barely, and only because global demand growth was temporarily slower than expected. That buffer is now gone. Demand is back at record levels, and Russia's ability to fill its traditional role in the global supply picture is permanently impaired. Now let us talk about the United States, because this is the part that almost nobody is discussing. The American shale revolution was supposed to be the insurance policy for the global oil market. Every time geopolitical tensions drove prices up, U.S. shale producers would crank up drilling, flood the market with new barrels within 6 to 9 months, and bring prices back down. That is exactly what happened in 2014 and 2018, and again in 2022. The shale industry was the market's release valve. That release valve is no longer working the way it used to. Here is why. The best shale acreage in the United States, the sweet spots, the Tier 1 locations in the Permian Basin and the Eagle Ford, has been drilled. Not fully depleted, but the easiest, cheapest, most productive wells have already been drilled. What is left is Tier 2 and Tier 3 acreage, where wells cost more to drill, take longer to reach peak production, and decline faster once they do. The economics of American shale have structurally worsened. The break-even price for new Permian wells has risen from around $45 a barrel 3 years ago to over $65 a barrel today. And here is the other thing that has changed. The major shale producers, the big publicly traded companies like ExxonMobil, ConocoPhillips, Pioneer, they are no longer in a growth at any cost mode. After getting burned by massive overproduction and debt in 2015 and 2016, and after the catastrophic demand collapse of 2020, the shareholders of these companies made one thing very clear. We want returns, not production records. We want dividends and buybacks, not a flood of new barrels that drives prices back down and destroys our margins. So the management teams of the largest U.S. oil producers are, quite rationally, limiting their capital expenditure and drilling programs even as prices rise. The shale release valve has been deliberately turned down by the investors who own these companies. Now add the geopolitical risk premium. The Strait of Hormuz is the single most important choke point in the global energy system. Approximately 21 million barrels of oil pass through that narrow stretch of water every single day. That is roughly 20% of all the oil traded globally. Iran controls the coastline on one side of that strait. And the current state of tensions in the Middle East, between Iran and Israel, between Iran and Saudi Arabia, between the various proxy conflicts that have escalated across the region over the past 18 months, creates a genuine, non-trivial probability of a Hormuz disruption event. You do not need Iran to fully close the Strait of Hormuz to trigger a price shock. You do not need a major war. All you need is one credible attack on a supertanker, one missile strike on a loading terminal, one naval incident that makes the insurance markets price a Hormuz transit as unacceptably dangerous. In 2019, when Iran attacked 2 oil tankers in the Gulf of Oman, oil prices spiked by 5% in a single day. That was during a period when global spare capacity was significantly higher than it is today. The same incident in today's market, with today's thin spare capacity cushion, with today's depleted strategic reserves, would not cause a 5% spike. It would cause a 30% spike in 72 hours. The shipping insurance market is already pricing this risk. War risk premiums for tankers transiting the Persian Gulf have risen by over 400% in the past 12 months. Marine insurers do not raise premiums 400% because they think nothing is going to happen. They raise premiums because their risk models are telling them something very uncomfortable about the probability distribution of the next 18 months. Here is the hidden layer that the mainstream energy coverage is almost completely ignoring. The world's emergency buffer, the strategic petroleum reserves held by the United States, Europe, Japan, and South Korea, is at its lowest level in 40 years. The United States Strategic Petroleum Reserve, the SPR, sits at approximately 350 million barrels today. That sounds like a lot. But in 2022, the Biden administration released 180 million barrels from the SPR over a period of months, specifically to keep gasoline prices from going higher during the political pressure of the midterm elections. That oil was released into the market at low prices. It has not been replenished. The U.S. government made a commitment to begin refilling the SPR, but the refilling program has been painfully slow, partly because the price of oil has remained too high for the Treasury to justify buying at current levels, and partly because the political will to allocate that spending has evaporated. What this means, practically, is that the emergency shock absorber that has been used to calm every major oil price spike since 1975 is nearly empty. When the next supply disruption hits, and based on everything I have just walked you through, the question is not if, but when. The United States government will not have the inventory to release 100 million barrels into the market to stabilize prices. The buffer is gone. The safety net has already been spent. And it was spent buying votes, not buying energy security. Now here's the second hidden layer, and this one involves the US dollar directly. Historically, When the dollar strengthens, oil prices tend to fall because oil is priced in dollars globally, and a stronger dollar makes oil more expensive in local currencies, which suppresses demand. But something has broken in that relationship over the last 24 months. The dollar has remained strong. In fact, it has been at historically elevated levels against most major currencies, and yet oil prices have not fallen the way the old model would predict. They have remained stubbornly elevated. The reason is that the countries driving demand growth, China, India, the ASEAN nations, are increasingly settling oil trades in currencies other than the dollar. The Saudi-China deal to accept yuan for a portion of oil payments was the first crack in the petrodollar wall. Since then, Russia has been pricing oil to India in rupees. Brazil and China have conducted direct currency swap agreements for commodity trades. The dollar's grip on the global oil pricing mechanism is loosening, and what that means is that the traditional pressure valve, dollar strength suppressing oil demand, is no longer functioning at full capacity. The demand signal from non-dollar economies is not being dampened the way it once was. The third hidden layer is the one that keeps actual petroleum geologists up at night. It is the underinvestment cliff. Between 2015 and 2021, global investment in new oil and gas production fell by over 50% relative to the levels needed to simply maintain existing production rates. The ESG movement, the shift of institutional capital away from fossil fuels, the political pressure on major banks to stop financing new oil projects, all of these forces combined to create a 6-year period where the world essentially stopped planting seeds for future oil supply. Not because the oil was not needed, because the financial and political environment made investing in new production too risky and too politically costly. Oil fields do not care about politics. They decline at their natural rate regardless of what is happening in the boardrooms of asset management firms. The average global oil field declines at approximately 6 to 8% per year, without constant new investment to maintain pressure and drill new wells. 6 to 8% of 100 million barrels per day is 6 to 8 million barrels per day of productive capacity that must be replaced every single year just to stay even. During the underinvestment period, that replacement drilling was not happening at the required rate. The depletion was outpacing the investment, and the wells that were not drilled between 2015 and 2021 are not drilling themselves now. That supply deficit is permanent. It is baked in. It cannot be fixed in 60 days, or 6 months, or even 2 years. So why 60 days specifically? Why is this the window where all of these forces converge? Let me show you the specific trigger events that are sitting on the calendar right now. The next OPEC Plus ministerial meeting is scheduled, and based on the communications coming out of Riyadh and Moscow, the alliance is not planning to increase production. In fact, the internal signals from the Saudi Energy Ministry, signals that have been picked up by commodity trading analysts who track these things professionally, suggest that Saudi Arabia is considering an additional voluntary cut of between 500,000 and 1 million barrels per day on top of the existing cuts. Specifically because the kingdom needs oil prices closer to $90 to $100 a barrel to balance its own national budget. The Vision 2030 social spending program, the massive infrastructure projects, the new Neom City, all of it requires oil revenue that current prices are not fully delivering. Saudi Arabia has every financial incentive to push prices higher, and they have the supply lever to do it. At the same time, the summer driving season in the United States is approaching. Gasoline demand in the United States spikes by approximately 8% between Memorial Day and Labor Day. Refineries that have been running at near maximum capacity to build up inventory are reaching the limits of what they can process. U.S. refinery capacity has actually declined over the past decade as older facilities were shut down and new ones were not built. The U.S. refining system is a bottleneck that amplifies any upstream supply shock directly into retail gasoline prices. And then there is the Iran situation. The diplomatic negotiations between the United States and Iran over nuclear sanctions relief have effectively collapsed. Without sanctions relief, Iran's ability to legally export oil remains severely constrained. And the hardliners within the Iranian government who have advocated for using the Strait of Hormuz as a leverage tool are in a stronger political position today than at any point in the last decade. The probability of a deliberate Iranian provocation designed to spike oil prices as a bargaining chip, as retaliation for sanctions tightening, or as a domestic political distraction, is not zero. It is meaningfully higher than the market is currently pricing. Now, let me bring this home, because I know some of you are thinking, okay, this is interesting global economics, but what does $200 oil actually mean for me personally? Let me be very specific. At $200 per barrel, the national average gasoline price in the United States goes to somewhere between $6.50 and $8 per gallon, depending on state taxes and regional refining costs. At $8 per gallon, filling a standard SUV fuel tank costs over $160 every week. For a household that drives 2 vehicles, you're looking at $300 to $400 per month in gasoline alone. double or triple what most American families are currently spending. That money comes out of somewhere. It comes out of restaurant spending, out of retail shopping, out of discretionary purchases. The consumer-driven American economy, which depends on people spending freely, hits a wall. But the gasoline price is actually the most visible effect, not the most damaging one. Every product that moves by truck in this country becomes more expensive. Every product made from petrochemicals, plastics, fertilizers, synthetic fabrics, pharmaceuticals, becomes more expensive. Food prices, which are already elevated after 2 years of inflation, spike again because agricultural diesel, synthetic fertilizers, and food transportation costs all move with oil. The grocery bill that Americans are already stretched by goes higher again. And unlike the inflation spike of 2021 and 2022, which was driven largely by pandemic supply chain disruptions that eventually resolved, an oil-driven inflation spike is persistent. It does not go away when the supply chain normalizes because the supply chain itself runs on oil. Your heating bill goes up, your airline ticket goes up, the cost of building materials for housing goes up, the cost of everything plastic, medical supplies, electronics components, packaging goes up. And because inflation goes up, the Federal Reserve faces another impossible choice: raise rates into a weak consumer economy to fight oil-driven inflation, or hold rates and watch the purchasing power of every dollar in your savings account continue to erode. Either way, you lose. Higher rates crush the housing market and your retirement portfolio. Lower rates let inflation eat your cash. The oil shock is the stone that ripples every other surface of your financial life. And before anyone in the comments says this is impossible, that oil has never gotten to $200, let me walk you through the history. In 2008, oil hit $147 per barrel in the span of about 18 months, driven by surging Chinese demand and tight supply, a combination that is almost exactly mirrored by today's conditions. The economy at that time had a housing crisis to deal with simultaneously, and the oil shock was one of the contributing factors that pushed the financial system over the edge. Goldman Sachs, in the middle of that run, published a research note predicting oil would hit $200. They were wrong at the time. Not because the supply and demand dynamics did not support it, but because the financial crisis crushed demand first. There is no financial crisis on the immediate horizon to crush demand this time. China's demand is structurally growing. India is in the early stages of an automobile ownership boom that will drive energy demand for the next 2 decades. The global middle class, particularly in Southeast Asia, is growing faster than any period in history. And every person who enters the middle class buys a car, installs air conditioning, and increases their energy consumption dramatically. The demand side of this equation does not have a 2008-style self-destruct mechanism this time. It is a one-way ratchet pointing up. In 2022, oil hit $139 per barrel within weeks of the Russian invasion of Ukraine. That spike happened in a market that had significantly more spare capacity than today's market. It happened before the SPR was drained. It happened before the shale cost curve shifted up. It happened before the underinvestment cliff fully materialized. The same geopolitical shock in today's market structure would be amplified by every one of the structural factors I have described. $139 in 2022 maps to $170 to $200 in today's tighter, thinner, more fragile market. Here is something else you should know. The smart money already knows this. The commodity trading desks at the largest hedge funds, the sovereign wealth funds of the Gulf states, the private equity firms that have been quietly acquiring energy infrastructure assets for the past 2 years, they are all positioned for significantly higher oil prices. You can see this in the options market, where the open interest in oil call options struck at 150, at 175, at $200 a barrel has increased dramatically over the past 6 months. Someone is paying real money to have the right to buy oil at $200. People do not buy $200 call options on a whim. They buy them when their analysis tells them the probability is real enough to justify the premium. The central banks of oil importing nations are quietly stress testing their economies for $150 and $200 oil scenarios. You can find these stress tests in the published financial stability reports of the European Central Bank, the Bank of England, and the Reserve Bank of India if you know where to look. They are not publicizing these reports. They are not holding press conferences to say we are modeling a catastrophic oil shock. But the documents exist, and the numbers in them are not reassuring. So what do you do with this information? First, stop assuming that the energy transition is going to save you from this. Solar panels and wind turbines are wonderful long-term investments for the grid. But right now, today, the global economy runs on oil. 83% of global primary energy still comes from fossil fuels. The transition is happening, but it is happening over decades, not months. And 60-day supply shocks do not wait for the clean energy transition to be ready. Second, think about your exposure. If you commute a long distance by car and you drive a large vehicle, your personal budget is the most directly exposed. If there was ever a moment to think seriously about fuel efficiency, electric vehicles, or shortening your commute, this is the moment. Before the shock, not after. After the shock, the dealers are sold out of fuel-efficient vehicles, and the wait lists are 6 months long. Third, think about your investments. Energy stocks, specifically oil majors and energy infrastructure companies, tend to perform extremely well during oil price spikes. The same market environment that destroys your grocery budget can potentially protect your portfolio if you are positioned correctly before the move happens, not after it is on the front page of every newspaper. This is not financial advice. This is pattern recognition from every major oil shock of the last 50 years. Fourth, and this is the one people always dismiss until it is too late, your food budget. If you have the storage capacity and the financial ability to build a modest buffer of non-perishable food staples, do it now. Not because you are a prepper, not because you think civilization is ending, but because oil-driven food inflation is not speculative. It is mechanical. The cost of growing food, processing food, packaging food, and shipping food all move directly with oil prices. A 3-month buffer of staple foods purchased at today's prices is a very rational hedge against what the food price environment looks like on the other side of a $200 oil event. The global oil shock nobody predicted is not going to announce itself politely. It is not going to give the mainstream media 3 weeks to run special reports and give experts time to explain it on cable news before it hits your wallet. It is going to happen the way all major market dislocations happen. Suddenly, violently, and before the majority of people have had any time to prepare. The supply structures that kept oil cheap and available for the last decade have been quietly eroding for years. The spare capacity that was the market's safety net has been whittled down to a sliver. The strategic reserves that were the government's emergency backstop have been spent. The shale release valve has been deliberately throttled by investors who want returns instead of volume. The geopolitical risk across the world's most critical oil corridors is at a multi-decade high. And the demand side of the equation, powered by 1 billion newly middle-class consumers across Asia, is not going anywhere. Every single piece of this picture is visible in public data right now. None of this is secret. None of this requires insider access or classified documents. It requires only the willingness to connect the dots that the news cycle, with its focus on the drama of the day, has completely failed to connect. That is why you are here. That is what this channel exists to do. The 60-day window is not a guarantee. It is a probability assessment based on known supply constraints, known demand trajectories, and specific documented geopolitical trigger events sitting on the calendar. The probability of a major oil shock within that window is high enough that the cost of being prepared is far lower than the cost of being caught flat-footed. You now know what the hedge funds know. You now know what the central bank stress testers know. You now know what the tanker insurance markets are already pricing. The question is what you are going to do with that knowledge. Before you go, I want to hear from you in the comments. And I mean a real conversation, not just a quick reaction. Tell me where you are watching from. I asked at the beginning, and I genuinely want to see how many countries this reaches. And then tell me this. Do you think $200 oil is coming in the next 60 to 90 days? Or do you think there's a factor that prevents it? I read every comment. I respond to as many as I can. And the comment section of this channel is genuinely one of the most informed communities on YouTube when it comes to energy and macroeconomics, because our viewers actually do their own research. So let us have that conversation below. If this video gave you information that you think someone in your life needs to hear, your family, your friends, a coworker who keeps asking why gas prices stay so high, share it with them right now. Not because it helps the channel, though it does, but because the people who are informed before an event like this can make decisions that protect their families. The people who find out about it on the news after it has already happened can only react. Share this and give someone you care about the chance to be in the first group. Subscribe if you're not already here and turn on the notification bell. We are going to be tracking every development in this oil supply story in real time as this 60-day window plays out. Every OPEC meeting, every tanker incident, every SPR update, every shale production number that comes in below forecast. You will get every piece of it the moment we publish. The storm is already forming. You can see it on the horizon if you know where to look. Now you know where to look. Stay prepared, stay informed, and I will see you in the next one.